Sean, thanks for joining us.
Thank you for having me. Good morning.
So I'm going to tee you up. Who's right, the bulls or the bears? We've seen so much stimulus in recent weeks and recent days. Who's right about the market and the economy?
Listen, in the long run, I usually think it's the bulls. But in this case, right now, we're seeing sort of the market trading sideways. And I think we're at a bit of a stalemate here between the bulls and the bears. And I kind of see it as, one camp as don't fight the Fed, and then the other camp is sort of don't fight COVID-19. On the Fed side and the bullish side, you look at all the stimulus that's come in the market, $6 trillion over just a few months, maybe 4 months. If you look at that on a daily average, that's about $50 billion in stimulus a day. And the bullish camp would say that that's backstopping markets and that limits the downside. And so far, that has been absolutely right. On the don't fight the COVID-19 side, you have the bearish camp saying, look at market valuations, they're extremely high, and look at the sharp rise in the number of infections, almost as sharp as the rise in the balance sheet. And I think what could win out on the bearish side eventually is if you see the recovery stall out, and maybe we don't fully recover as well as the bullish camp thinks with the V-shaped recovery.
All right, Sean, we're going to have you explain what a lazy V is in just a moment. But first, don't the bears have more supporting evidence to their argument, especially with the $600 of extra unemployment payments expiring in the future, where we don't really know where the virus is going?
Right. I actually think that's going to be probably more critical to Wall Street towards the end of July than a lot of people think. We actually got a report from the NBER this morning, or yesterday it was released, saying that 2/3 of those that are unemployed are actually receiving income above their normal levels. When you get that extra $600 a week in unemployment insurance, it does two things. One, it disincentivizes you to return to work potentially, but it also provides really key income support. So if you have 2/3 of people on unemployment right now and they're actually receiving benefits that are greater than they would normally receive, that's keeping consumer confidence higher than what you would normally see with the unemployment rate where it is. So you have this risk of an income cliff at the end of the month if Congress doesn't either extend the CARES Act or do the HEROES Act with some sort of replacement. And I think that is a risk that we need to consider, that consumer confidence may be being bolstered by this notion of this key income support. If that gets removed and the infections continue to rise and people aren't able to return to work because their business has been closed or the reopening's been stalled, then I think that poses a risk that we're maybe not fully considering just yet.
So again, what's this lazy V? We all know what a V looks like. What end of the V is lazy, and how do we get it to an energetic, actively working out V?
Sure. So my definition of a lazy V kind of looks like the chart of the Dow Jones you just showed, or ironically, it kind of looks like the hand symbol you make when you're asking for the check at a restaurant, where you have a sharp down and then kind of a lazy recovery. I think what happens when you have bars being closed, that's just 400,000 people employed in bars in February. So maybe that's not that important. But at the end of the day, arts, entertainment, sports complexes, all those things that may be delayed, employ about 1.5 million people. Then you look at weak airline transportation, which you just had on the previous segment. You can't fully recover without those things. So until we kind of beat the infection or it fades or we're able to have international tourism again and international flights, I can't imagine a scenario where we fully recover, even though thus far the recovery's been much sharper than a lot of people thought. And if you look at the PMI data, it definitely looks like a V. But at the same time, on the services side, the employment component is still in contraction. We can't fully recover until we get that in place.
So, Sean, you do see a recovery coming. What kind of stocks should investors be looking at? Should it be value? Should it be growth, cyclicals? Kind of give us a sense in 30 seconds.
In 30 seconds, sure. So we think it comes down to one fundamental question. There's a ton of noise right now, but at the end of the day, we ask the client, do you think the economy is going to be better in 12 to 18 months from now? Uniformly, I think the answer to that is yes. So if you think the economy is going to recover in 12 to 18 months, then normally it's cyclical companies that tend to do better.